Good evening. We begin tonight with a developing story from the financial markets that has captured the attention of traders, institutional investors, and policy analysts across the globe. A significant and historically unusual short position has accumulated against United States Treasury bonds, and market observers are now raising the possibility of what could become a rare and potentially dramatic short squeeze in the government debt market. This development carries implications not only for those directly involved in bond trading, but also for the broader economy, given the central role that Treasury securities play in the global financial system. To understand the gravity of this situation, it is important to first recognize what makes this scenario so exceptional. Short selling, a trading strategy in which investors bet that the price of an asset will decline, is a common practice in equity markets. Stocks of companies such as GameStop, Volkswagen, Hertz, AMC Entertainment, and Tesla have all experienced short squeezes in recent years, where a rapid rise in price forced short sellers to buy back shares at higher prices to limit their losses, further driving up the price in a self-reinforcing cycle. However, short squeezes in the bond market are far less common, and a short squeeze involving United States Treasury securities is virtually unprecedented in modern financial history. The United States Treasury bond has served as the benchmark for the entire fixed income market since the period following World War II. Its interest rates have been used as reference points for pricing countless other debt instruments around the world. The stability and reliability of Treasury securities have long been associated with safety and have earned top-tier credit ratings from agencies such as Moody's and Standard & Poor's. For decades, the relatively low volatility of Treasury bonds has made them attractive to a wide range of investors, including exchange-traded funds and traders seeking predictable returns in a liquid market. Yet recent years have brought a series of economic and policy developments that have led a growing number of market participants to take short positions against Treasury bonds. Several factors have contributed to this trend, and understanding these elements is essential to grasping why the current situation has evolved and why the potential for a short squeeze now looms. One significant factor has been the elevated inflationary environment that emerged in the wake of the global pandemic. Inflation in the United States reached a peak of 9% in June of 2022, a level not seen in decades. Rising inflation typically erodes the real value of fixed income securities, because the interest payments and principal repayment are worth less in terms of purchasing power. In anticipation of declining bond prices and rising yields, many traders established short positions in Treasury securities. This was a logical trade from the perspective of those who believed that inflation would remain elevated and that the Federal Reserve would be forced to raise interest rates significantly to combat it. Another consideration that has influenced market sentiment is the perception that the value of Treasury securities has been undermined by what some critics describe as excessive money creation. Over the years, fiscal policy decisions have led to substantial increases in government spending, often financed by the issuance of new debt and accommodation by the central bank. Critics argue that this has debased the currency, reducing the real value of assets denominated in United States dollars, including Treasury bonds. For investors concerned about long-term purchasing power, this has been a reason to reduce exposure to government debt, or even to bet against it. At the same time, there has been a notable surge in the prices of precious metals, particularly gold and silver. Traditionally, gold has been viewed as an alternative store of value, especially during periods of currency instability or uncertainty about the future path of monetary policy. As gold and silver prices have climbed, some investors have shifted their portfolios away from Treasury securities and toward these tangible assets, contributing to selling pressure in the bond market. International demand for United States Treasury securities has also shifted in meaningful ways. China, which was once the largest foreign holder of United States government debt, has reduced its holdings substantially over the past decade. As of November 2025, China's Treasury holdings stood at $682.6 billion, down from a peak of $1.32 trillion in 2013. This gradual reduction has occurred across multiple presidential administrations and reflects a long-term strategy of portfolio diversification by Chinese authorities. While this reduction has been orderly rather than abrupt, it nonetheless represents a significant change in the composition of demand for Treasury securities. Monetary policy itself has also played a role in shaping the environment for Treasury bonds. The Federal Reserve maintained a cautious approach to interest rate cuts through the latter part of 2025. After implementing 3 quarter-point reductions in the final months of the year, the target range for the federal funds rate was brought to 3.5% to 3.75%. However, inflation remained above the Federal Reserve's 2% target, which kept bond yields elevated and contributed to the challenging environment for Treasury prices. In addition to these macroeconomic factors, technical and structural elements of the bond market have contributed to the buildup of short positions. Leveraged exchange-traded funds, which seek to amplify returns through the use of derivatives and borrowing, often maintain sizable short positions in 10-year and 30-year Treasury futures contracts. These positions are used to enhance liquidity and facilitate the fund's investment strategies. For these products, even small movements in bond prices can generate profits if the position is large enough. A move of just 5 basis points or more can be sufficient to produce gains given the volume involved. Conversely, if the market moves in the opposite direction, the high liquidity of the Treasury market typically allows these entities to exit positions quickly with manageable losses. What makes the current situation particularly noteworthy is the sheer size and concentration of short positions that have accumulated. According to data from the Chicago Board of Trade, the short position in United States Treasury futures has reached approximately 1.97 million contracts. Market analysts describe this as an extremely crowded trade, and some suggest it may represent one of the largest short positions in the history of the long bond market. In addition, total short interest across exchange-traded funds focused on Treasury securities is estimated at roughly $12.4 billion. Short interest in Treasury Bill instruments stood at 89,585 shares as of November 2025. The concentration of these bets against Treasury securities has raised concerns about what might happen if market conditions were to shift suddenly in favor of bond prices. In a short squeeze scenario, a rise in bond prices forces short sellers to buy back the securities they have borrowed and sold in order to close out their positions and limit losses. This buying activity can drive prices even higher, which in turn forces additional short sellers to cover their positions, creating a self-reinforcing upward spiral. The more crowded the short trade, the more violent the potential squeeze. Several recent developments have led some market participants to believe that conditions may now be aligning for a reversal in the Treasury market that could trigger such a squeeze. These factors represent a significant shift from the environment that initially encouraged traders to bet against government bonds, and they merit careful examination. One key development is the apparent success of policy measures aimed at controlling inflation. The current administration has implemented a range of economic policies, and there are indications that inflation has been tamed and may even be beginning to reverse. Lower inflation is generally supportive of bond prices because it reduces the erosion of purchasing power that fixed-income investors face and may lead the Federal Reserve to cut interest rates further, which would boost bond prices. Another factor that has strengthened the fiscal outlook is the implementation of tariffs on imported goods. These tariffs have generated substantial revenue for the federal government and have contributed to a significant reduction in the United States trade deficit. A smaller trade deficit and increased government revenue from tariffs have provided support to the United States dollar, which in turn makes dollar-denominated assets such as Treasury securities more attractive to international investors. In addition, the United States government has secured control over certain foreign oil assets, specifically those in Venezuela. This control over tangible energy resources provides another source of value that can help mitigate concerns about currency devaluation. By holding productive assets that generate real economic value, the government is seen as having a stronger backing for its debt obligations. Market signals from the Treasury auction process have also been more positive than some had anticipated. A recent auction of 20-year Treasury bonds performed above expectations, with strong demand from investors. This suggests that there remains robust underlying interest in government debt, particularly at current yield levels. There has also been attention focused on the leadership of the Federal Reserve. The Department of Justice recently initiated an investigation into Federal Reserve Chair Jerome Powell related to his congressional testimony concerning renovation costs for Federal Reserve buildings. Powell has characterized this investigation as politically motivated. The investigation has led to speculation about the possibility that Powell might choose to retire earlier than the departure date he announced in May. Any change in leadership at the Federal Reserve could have significant implications for monetary policy and market expectations, potentially influencing bond prices. The dynamics of the repurchase agreement market, commonly known as the repo market, add another layer of complexity to the current situation. The repo market, valued at approximately $12.6 trillion, is a critical part of the financial system's plumbing, providing short-term funding to a wide range of institutions. If conditions in the repo market were to tighten, or if collateral dynamics were to shift, it could trigger significant movements in Treasury prices as participants rush to adjust their positions. For those holding short positions, such a move could necessitate rapid covering, adding to upward price pressure. Furthermore, the structure of leverage in the financial system creates the potential for forced liquidations. Hedge funds and exchange-traded funds that maintain short positions on margin can face margin calls if bond prices rise and their positions move against them. When margin calls occur, these entities are forced to buy back Treasury securities to meet their obligations, regardless of their views on the fundamental outlook. This forced buying can amplify price movements and contribute to the dynamics of a short squeeze. Market analysts and economists who follow the Treasury market closely are now considering the possibility of significant price movements in the near term. Some suggest that a move of 25 to 50 basis points in yield could occur quite suddenly. Given the size of the short positions currently outstanding, if covering activity were to become disorderly or panicky, daily moves of 20 basis points or more would not be surprising. Such volatility would represent a dramatic departure from the relatively stable environment that has characterized the Treasury market for much of its history. To provide context for how unusual this situation is, it is worth reflecting on historical precedents for large-scale short squeezes involving sovereign debt. One of the most famous examples is the trade executed by investor George Soros against the British pound sterling in the early 1990s. Soros bet that the pound was overvalued and that the British government would be unable to maintain its currency peg within the European exchange rate mechanism. When the Bank of England ultimately capitulated and allowed the pound to devalue, Soros netted a profit of approximately $1 billion. That episode demonstrated that even the resources of a major developed nation can be insufficient to defend an asset against determined market forces when fundamental conditions are unfavorable. However, sovereign nations have considerable tools at their disposal to defend their currencies and debt instruments. Governments can deploy foreign exchange reserves, adjust monetary policy, implement capital controls, or seek assistance from other nations or international organizations. For example, just a few months ago, the United States provided a currency swap arrangement to Argentina, which helped stabilize that country's financial situation. According to Treasury Secretary Scott Bessent, the arrangement has already generated a profit for Washington, demonstrating that such interventions can be mutually beneficial. In the case of United States Treasury securities, the situation is even more complex because the United States government has unique advantages. The dollar remains the world's primary reserve currency, and Treasury securities are held by central banks, sovereign wealth funds, pension funds, insurance companies, and a vast array of other institutional and individual investors around the globe. The depth and liquidity of the Treasury market are unmatched, and the Federal Reserve has demonstrated repeatedly that it has the tools and the willingness to intervene in markets when it deems such action necessary to maintain financial stability. Nevertheless, the current configuration of the market, with record short positions and a changing macroeconomic backdrop, has created a scenario that many observers find compelling. The potential for a short squeeze in Treasury securities is being discussed openly in trading rooms and in financial media, and positioning decisions are being made with this possibility in mind. It is also important to note that the implications of a Treasury short squeeze would extend far beyond the immediate gains or losses of the traders involved. Treasury yields serve as the foundation for pricing throughout the fixed income market. A sudden drop in yields due to a short squeeze could affect mortgage rates, corporate borrowing costs, municipal bond prices, and the valuation of a wide range of financial assets. For savers and retirees who depend on fixed income for their livelihoods, changes in Treasury yields can have direct and meaningful impacts on their financial security. Moreover, the Treasury market plays a central role in the conduct of monetary policy. The Federal Reserve influences economic activity largely through its impact on interest rates, and Treasury securities are a primary channel through which monetary policy is transmitted to the broader economy. Disruptions or unusual volatility in the Treasury market could complicate the Federal Reserve's ability to achieve its dual mandate of maximum employment and stable prices. The current situation also raises questions about the behavior of leveraged financial instruments and the risks they may pose to market stability. Exchange-traded funds that use leverage and derivatives to amplify returns have become increasingly popular in recent years, offering investors the ability to gain magnified exposure to various asset classes. While these products can serve useful purposes and provide liquidity, they also have the potential to amplify volatility, particularly when large numbers of market participants are positioned in the same direction. The presence of substantial leveraged short positions in Treasury futures is a factor that regulators and market participants are watching closely. In addition, the role of foreign holders of United States debt remains an important consideration. While China has reduced its holdings significantly, other countries and entities continue to hold large amounts of Treasury securities. Japan, for instance, remains a major holder of United States government debt. The decisions made by foreign governments and central banks regarding their Treasury holdings can have significant effects on yields and market dynamics. Any shift in sentiment or policy by major foreign holders could either exacerbate or alleviate the conditions that might lead to a short squeeze. The interplay between fiscal policy, monetary policy, and market dynamics is at the heart of the current situation. Fiscal policy decisions, including levels of government spending and taxation, determine the supply of Treasury securities that must be absorbed by the market. Monetary policy, as conducted by the Federal Reserve, influences the demand for those securities and the level of interest rates. Market participants, ranging from individual investors to large institutions, respond to these policy signals and to their own assessments of economic conditions, creating the prices and yields that we observe. What makes the present moment particularly interesting is that multiple factors that had been pushing in one direction, toward higher yields and lower bond prices, may now be shifting. If inflation continues to moderate, if fiscal policy becomes more disciplined, if foreign demand stabilizes or increases, and if the Federal Reserve signals a more accommodative stance, the environment for Treasury securities could improve markedly. For those who have bet heavily against government bonds, such a shift could be costly. It is worth emphasizing that the analysis presented here is based on observable market data and reported developments. The size of short positions, the level of yields, the statements of government officials, and the results of Treasury auctions are all matters of public record. The assessment that a short squeeze is possible is not a prediction, but rather an observation of the conditions that could give rise to such an event. Markets are inherently unpredictable, and many factors could influence the outcome. Traders and investors are known to be attentive to historical patterns and analogies. The phrase, "may you live in interesting times," has been variously attributed to an ancient Chinese curse or to a British expression, though its precise origin remains uncertain. Regardless of its source, the phrase captures the sense of uncertainty and potential upheaval that characterizes periods of significant market stress or transition. By that measure, the current environment in the Treasury market certainly qualifies as interesting. For those with substantial savings and investment portfolios, the developments in the Treasury market are particularly relevant. Fixed income securities have long been a cornerstone of retirement planning and wealth preservation strategies. The safety and predictability associated with Treasury bonds have made them a preferred choice for conservative investors. However, the events of recent years, including the inflation surge and the subsequent policy responses, have reminded investors that even the safest assets are subject to market forces and can experience periods of volatility. Financial advisors and wealth managers are closely monitoring the situation and considering the implications for their clients. Those with significant exposure to bond funds or to leveraged products tied to Treasury securities may need to reassess their risk profiles. Conversely, if a short squeeze were to occur and bond prices were to rise sharply, those who maintain positions in Treasury securities could see gains that offset some of the losses experienced during the period of rising yields. The current discussion also highlights the importance of understanding market structure and the mechanics of trading. Short selling, margin requirements, forced liquidations, and the functioning of futures markets are technical topics, but they have real-world consequences for prices and for the financial well-being of market participants. Education and awareness about these mechanisms are valuable for anyone engaged in investing or financial planning. As we continue to follow this developing story, it will be important to monitor several key indicators. Treasury yields, particularly those on the 10-year and 30-year bonds, will provide signals about market sentiment and the direction of prices. Data on short positions, which are reported regularly by exchanges and regulatory bodies, will show whether the crowded trade is being unwound or whether it is growing even larger. Statements from Federal Reserve officials, particularly regarding the outlook for inflation and interest rates, will be closely scrutinized for clues about future policy moves, and developments in fiscal policy, including any changes to government spending, taxation, or trade policy, will influence the supply and demand dynamics for Treasury securities. International developments will also be relevant. Geopolitical tensions, changes in foreign economic policy, and shifts in global capital flows can all affect the demand for United States government debt. In an interconnected world, events in one region can have ripple effects throughout the financial system, and the Treasury market is not immune to these influences. In summary, the financial markets are facing a situation that is both unusual and significant. A historically large short position has built up against United States Treasury securities, driven by concerns about inflation, currency debasement, and shifts in demand. At the same time, recent policy developments and market signals suggest that conditions may be shifting in a way that could favor bond prices. If that shift occurs, the result could be a short squeeze of considerable magnitude, forcing those who have bet against Treasury securities to buy them back at higher prices and potentially creating a self-reinforcing cycle of rising prices and falling yields. The implications of such an event would extend throughout the financial system, affecting borrowing costs, asset valuations, and the conduct of monetary policy. Market participants, policymakers, and observers are all paying close attention to the unfolding dynamics, aware that the Treasury market, long a symbol of stability, is now the site of one of the most closely watched and potentially consequential trades in recent financial history. This concludes the first part of our coverage. We will continue with a detailed examination of the specific factors driving this situation when we return.